So thank you for coming to today's webinar on price action trading. My name is Chris Capre, and so I am a full-time trader, and I want to say part-time teacher, but it's becoming full-time just because demands are continually increasing with this. Although I have been trading a little bit less lately as a whole. I'm trading a little less as a whole right now because I'm writing a book. So writing a book, managing a fund, personal trading, running a website, and consulting for a company because I'm building a new trading platform for currency trading definitely makes it difficult for me to do all kinds of, trading for myself. So while I'm writing the book, I'm definitely doing a little bit less, but I'm still pretty active, and I've been very active lately, especially yesterday and today, and I want to talk about the price action setups that I've been looking at, some of them that I did some trades on, how I spotted the patterns from a price action perspective, what I was interpreting. I also want to go over an example of something that came up. I wrote an article recently on pin bars. In fact, I think I have a link to that. And I want to go over a particular trade because a question came up. Let me write this down here. I'm making a note to myself. Great. Okay, so a question came up on this in the article, and I thought this would be a really good example to address in today's webinar. So we're going to do that. I want to get into oil, then I'll get into the chart in question from my pin bar article. For many of you are asking, here is the article that I wrote about it. And so feel free to check that out. Or I have another link to it can find right here as well. So feel free to check that out as well. Okay, great. So that's what we're going to begin with. We're going to begin with the chart on oil. We're going to talk about pattern recognition, how I use this pattern to spot a really good trade opportunity and how I traded it from a price action perspective. Then I'm going to be talking about a pin bar setup on Aussie dollar and why there was a question on this from one of the students. And then I'm going to get into dollar yen and euro yen. In fact, for those of you not on my Facebook, I actually pinned about it on my Facebook ahead of time saying, hey, I'm looking to buy euro yen, dollar yen. And so I talked about that. And then if I have time, I'm going to get into the Dow. So I want to talk about the Dow and where I see a possible turning point in the Dow that may or may not already be in play. Okay. So looking at this oil chart here, oil's been, in a very strong uptrend for a very long period of time, very stable relationship to the 20 EMA. It starts to break below this, and I want to zoom into something very interesting here. So we have a sell-off here, and the sell-off is kind of orderly. And what do I mean by orderly? It kind of has a general rhythm to it, and it has a general kind of as a pseudo channel-like structure to it. It's not totally perfect, but it's kind of there. So it's relatively orderly, and there's some elements to this, which is that, it has a strong red candle, then a few, corrective candles, and then some strong red selling, and then a few corrective and strong red selling. And so, that tells us that the sellers, it wasn't just a one-way market for the sellers. It was the sellers, were fighting some of the longer-term buyers that were involved in the large uptrend. Many of you have been watching oil. If you have been, you notice oil has just been on a tear, constantly gaining, And so with that being said, they're probably fighting some of the long-term buyers in here, which is why you're getting some pushback. But the sellers still maintain control. Now, this is where it gets interesting. Take a look at this here. I want to delete this line. Take a look at this here. So price hits the floor, bounces a little bit, goes to 20 MA. Very strong selling makes a new low. But then all of a sudden, and we have a 50 pip rejection on the bottom of this candle, which by itself, considering the size of this candle, would not necessarily mean anything. But the fact that it was followed up with another candle that opened at 105.59, it only went down 9 pips and then launched up and took out the open of this candle, tells you something. It begs the question, wait a minute. First off, there were strong sellers involved in this candle. Where did they all go? Second of all, there were sellers from 110 down to 105. Where did they all of a sudden evaporate out of the market? when you see these kinds of strong, trend environments or stable trend environments, and then all of a sudden you get, kind of a very strong reversal candle like this. It's not an engulfing and it's not an outside bar because it doesn't eclipse the lows here or the highs here, but it's a very, very strong reversal candle. And so with that being said, when you have these back-to-back like this, especially on a higher time frame like a 4-hour or daily, it should beg the question, wait a minute, where did all the sellers go? They were present for, $5 sell-off on it, and they were present when this thing was selling on the break, and so where did they all go? And so the fact that this had a rejection by itself, not that big a deal. The fact that it had a rejection followed by very strong buying that took out all the losses on this candle communicates, wait a minute, they ran into a line in the sand, and that line in the sand was the bulls saying very clearly, you're not getting past this. You've tried, you've been dropping $5, we're going to punch back, and we're going to punch back harder than you are. And so what happens after that? The price sits on another line, let me draw the line right here, for about another 5 candles. Now, I would like to point out a couple pieces of symmetry here. Here's the low, and then we have 1, 2, 3, 4, and then the big candle here. And then again, we have 1, 2, 3, 4, and then look what happens after this. And I want you to watch this pattern. Boom. Price launches up right after this and takes off. So you should see the pattern here. You could call it, a head and shoulders. It really wouldn't be a head and shoulders because to have the traditional head pattern, you would need a much, longer head. If we zoomed in on a smaller time frame, we might have a head and shoulders pattern. I really don't care about head and shoulders patterns. What I do care about is that after 4 hours of strong selling, along with $5 in a sell-off, it ran into one candle that completely eclipsed all the losses of the prior candle. And then right after that, the sellers never came back. The sellers just evaporated in the face of that, telling us they're not interested in getting in front of this candle here. And what happens? The market takes off right after that. Now, fast forward a little bit. Do y'all see the same pattern? Can you guys see where it's at? Yes, no? Does anybody see it? It's almost the exact same pattern. Let me zoom into it for you. Here it is again. Strong selling from 107.5 down to 104. We have kind of a flag pattern, and then we have a very strong selling candle. Incredible candle. It's a $2 sell-off in 4 hours. Over $2. What happened? Decent rejection, but then the next candle is exactly the same. It opens, has very small selling to the downside, is immediately bought up, takes up almost all of the losses on this right here. Could be exhaustion. It's definitely a possibility. Or the bottom line is the sellers just ran into some buyers who said, we think long-term oil is going to continue to gain and we'll be happy to buy here. Whatever it was, it doesn't matter. It's the same pattern again. And then again, look at it. You have, here's the bottom on this candle right here. And then we have 1, 2, 3, 4, plus the big selling candle, big buying candle. 1, 2, 3, 4. So to me, this was a no-brainer trade setup. It was an absolute no-brainer trade setup. Buy on open, stop just below the low of this, target recent highs. Let me show you where, right here. Go just a little bit below it. And there you go. The exact same pattern. So can everybody see from a price action perspective why I took this trade, how I was able to spot the pattern, how I was able to relate it to the prior history, and then say, okay, there's a trading opportunity here. Same play. Back over here, you have your sell-off 1, 2, 3, 4, big selling candle, big buying candle, 1, 2, 3, 4. Buy on open. Stop just below the lows of this little bottom right over here. Target prior tops. You have a fantastic R to R on these trades. I mean, here is a dollar stop, and you have a $2.77 target, the 2.7 to 1. On this one, I was afforded a much better play because the lows on this one were much closer to the low of the prior one here. Entry, stop, not even a 50-cent stop, and a target of 107.60. Over a $2.10 target, 4 to 1. So, can everybody see how I took this setup, why I took the setup, how I was able to spot the pattern, how I made the trade, why I made the trade? Can everybody see that? Yes, no? Does everybody understand the price action components? All the, the price action patterns and the order flow behind it that I was explaining and how it all plays into that. Does that make sense? Yes, no? Okay, great. So let's see. Manoj, I think I answered your question. Fernando says, one of these days, will you dedicate a session for targets? Really good topic. Will I dedicate a session for targets? I would do that. I think the first thing I would want to do is dedicate a session to stops first. And let me tell you why. Professional traders, when they get in a trade, the first thing they're thinking is not the target. The first thing they're thinking is risk. In fact, that's how you know you can separate a professional trader from, a developing trader. Is that developing traders, when they get in a trade, their eyes are on the target and they're thinking, oh my God, I should get in this trade. I could be making, 200 pips on this one here. But they're not looking at the risk. The first thing they're looking at is the target first. And so, that's how you haven't developed or fully matured as a trader when the first thing you're looking at is the target. The first thing you should be looking at is the stop. The first thing you should be calculating is the risk, because that's the most important thing you're concerned with. In fact, I've been looking to write an article. I'll probably write one this weekend. 5 or 6 signs that you've matured as a trader. This is one of them. This is absolutely critical. And so, in terms of creating a session on targets, I would want to do one first on risk, because that's and setting up stops, because to me that's far more critical. If you really have landed as a trader, you realize you're spending more of your time managing risk than anything else. You're managing your risk and you're neutralizing risk, and you're always looking for ways to manage and neutralize risk before you do anything else. Because if the risk doesn't pan out, then it doesn't matter what the target is, it's not worth it. You have to abandon the trade. So we wouldn't ever want to start with targets first. Does that all make sense on the difference between starting with risk first and starting with targets first? Yes, no? Okay, great. All right, so hopefully that makes sense. All right, with that being said, I want to get into this Aussie dollar trade. This is one that was a topic. I wrote an article on pin bars, which I sent the link in earlier. And the trader sent me a question here saying, hey, I got a pin bar formation. And for those of you who don't, again, know what a pin bar is, go back to that link there. So, with this being said, a pin bar showed up, and it showed up at a very nice place. It's at the top of an up move, lines up with some prior resistance here. And their question was this: if you get a pin bar on a 4-hour time frame, but you realize on a smaller time frame that this pin bar formed as the result of, say, 15 minutes of price action instead of over the 4 hours, do you consider it a valid signal? It's an excellent question, because part of the methodology in trading 4-hour charts is, if you think about it, a 4-hour candle, no matter how you slice it, is half a trading session. It will always be half a trading session. So with that being said, most trading sessions are 8-9 hours. So the 4 hours of price action will always be equivalent to half of a trading session for the most part. That's a lot of price action. That's a lot of orders. That's a lot of transactions, a lot of order flow, a lot of sentiment. A lot of traders have participated in half that trading session. So if a pin bar forms on a 4-hour candle, you're talking half of an entire session has rejected a key level and formed a possibly very strong reversal pullback or trend continuation signal, depending upon how it's placed. And so that's critical. So when it forms on the 4-hour, that tends to be very strong. Contrast that to a signal that happens on the 5-minute chart, and that's very different. It doesn't take much to form a 5-minute pin bar. Think of how many transactions and orders are executed during that 5 minutes. Compare that to 4 hours. Now, this person had a question that tried to subvert the logic. What happens if the pin bar is actually the result of 15 minutes of price action? Then does it still make sense? And here's what they were seeing. Let me zoom out. So here's the pin bar. It actually happens, the candle starts here. Sorry, it starts here at 9 and goes to 1. Let me delete that. And so here's the general body of the pin bar. It explodes up in 15 minutes, and then it sells back down. So my answer to him was, yes, it's still a valid pin bar for a couple reasons. One, most of the price action was suppressed to the lower end of this range, telling us there was suppression of the price action. But two, we have to ask the question again, very much like the oil chart. Okay, so we have all of a sudden an explosion of buying. We have some buying on the Aussie dollar that in 15 minutes it climbs from 1608 to 1636. 30 pips roughly in 15 minutes. Now we have to ask the question, since price had returned back to that, where did all the buyers go? If the buyers were present in the market, where did they go? Why did they all of a sudden just evaporate out of the market in thin air? It doesn't make any sense. So it tells us, regardless of the fact that this 115 candle really formed the high-end point of this rejection, they left the market in a mass exodus. And so because they had done it, it should be communicating to us from an order flow and price action perspective that this pin bar is valid, because the whole point of it is saying, hey, there's going to be a reversal play here. So I said yes based on that. And so does that all make sense? Why this would still be a valid pin bar, even though the price action was formed roughly over one candle? Actually save a few more. Does it make sense? Yes, no? Not total congruency here, but okay, great. All right, so it makes sense. All right, so with that being said, they actually were able to get short on this anyways, and they obviously did very nice on this. Price dropped over, 150 pips, and some of my price action traders got in on this one as well. We had spotted this setup ahead of time. We'd all talked about it, put it on the forum, and so, with that being said, some people were taking advantage of this as well. All right. Let me look at my list here. I'd really like to get into dollar yen and euro yen real briefly, but Sylvester seems to be very keen on getting something on Kiwi dollar and gold. Since we're moving along at a good place, by the way, is this the Sylvester that I know? I know a Sylvester that I worked with in Australia. Just curious if this is that person. So, but regardless, Sylvester, since we're moving along at a very fast pace, I think I can get to dollar yen and euro yen and then still get to your Kiwi and gold. So if that's okay with you, I'd like to finish those, and then we'll get into those. Okay, great. I appreciate your patience. All right, great. So let's look at a dollar-yen trade. Patricia, PLIU, are you really asking this question? Really? Really? The reason why I'm asking you, Patricia, the reason why I'm asking PLIU if she's asking this question, because this is a question that has filtered out from our course that's now making its way into the forum, or it's now making its way into the webinar here. And so, please, PLIU, please read my most recent response in the forum, and that will answer your question. In terms of how big this body is, I don't know. Open, close. Yeah, it's about 1 pip. But again, please read my post on the forum. I answered this question in the forum. So try not to get caught up on the details. It's very important. Okay, so with that being said, dollar-yen. All right. Thank God I'm out. Okay, so dollar-yen, actually I should start with the daily. Okay, so I wrote about this in both on my Facebook and I blogged about it as well. Do you see how we have this kind of 3 doji-like pullback? Very rarely ever do tops have these kinds of formations. You know, very strong blue bar and then 3 doji-like pullback. Very rarely do tops have, 3 doji pullback and then the next bar just like sells off massively. It generally doesn't work like that. If you see the 3 dojis, it can usually be a chop. If you see 3 dojis to where it's a reversal, it can usually be chop or maybe a mix of blue and red. There may be an inside bar in there somewhere. But rarely ever do we see a big blue bar, slow 3-step pullback, and then we see massive selling from there. Tops don't work like that. In fact, if you look at historically at tops on charts, you will see that rarely ever do they look like this. And so, with that being said, here I was just the other day watching this on the 1 hour, and this is what I noticed. Okay, so we obviously have a floor here at 818. Price had touched it a couple times. Rejected off of it, bounced a little bit up to 83.90, so about 70 pips. Rejected off of it, much flatter rejection, telling us that the buyers didn't come in and force this time. And then what happens is we break through it there. So the sellers were able to, maintain control from this rejection. We have a corrective move after this and selling off. We break the lows. But then look what happens shortly after that. Price breaks right back into the range. It did not take long for price to break back into the range. So price breaks back into it, telling us, guess what? All the sellers that were taking advantage of this, in the short term from here all the way down and breaking, they've left the market. They're gone. If they really were present in the market, why did the first candle of breaking out of those lows, all of a sudden yield control to the bulls who stopped it just shy of 83? It doesn't make any sense. Also, why did the fact that the bulls all of a sudden for 4 hours in a row bring up price and break back into the range? It doesn't make any sense. So I'm sensing false break. Well, if I'm sensing false break, if this was the lows right here, then I want to look for a pseudo low close to that, with the stop just below this here, giving me a very tight stop, and then targeting, somewhere a little bit higher, maybe right about here, or maybe here. I only need a 2-to-1 R to R on this. Well, if I have a 23 pip stop, I need 46 pips of target, which would put it around 83.70. Well, look what happens. Pulls back right to the bottom of this same support level, stalls for a little bit, London session ending, and I have to admit, this thing definitely tried my patience. But then 20 MA starts to hold, It starts to get strong off the 20 EMA, and finally you see it continue to hold further, telling us this thing's going to probably break the highs of the day, and it does so in the London session finally. Makes it pretty darn close actually to these highs as well before pulling back. So can everybody see how I was able to take this false break trade and turn this into a trading opportunity, and then how the fact after it rejected off the same level, then used the 20 EMA as support, all eventually communicate to me, okay, this is taking a long time, but I'm continually seeing support build and build and build and build. I actually posted this on my Facebook ahead of time saying, hey, I'm looking to buy dollar yen and euro yen. Posted this well ahead of time. I think I even posted it right before the London closed. Can everybody see that? Ganster says, his question here, what does price action communicate to you when it breaks the 20 EMA about 2 times consecutively on the other side? Do you mean if it flips on it, both sides? There's my Facebook ID. Okay, so, if it's flipping on it on both sides, and the 20 EMA is moving horizontal, that should be communicating that there is no price acceleration. There's no buyers, there's no sellers. Well, there are, they're just not coming in force. Nobody has an opinion about price or not strong enough to the point where they're willing to commit large amounts of money to it. If they were willing to commit large amounts of money to it, then we would see somebody take directional control of the market. But that's not what we're seeing. So when price just sits there like this, then nobody's really in control. Liquidity's out of the market. After we finally popped above it here, we were chopping on it on both sides here, and I'll confess, I was sitting there going, not exactly excited about it. It doesn't inspire me, but it also doesn't hurt me because it's not saying anything negative. It's not saying anything negative, and it's not saying anything positive. So, okay, fine. Well, then I just wait. It hasn't hit my stop, hasn't even come back to my entry. Continue on with the trade. Well, eventually the 20 EMA starts to track as support. In fact, we can't even get a close below. We have 1, 2, 3, 4, 5, 6, 7 touches off of it. No closes. That tells me that the buyers are slowly taking over the market. They're starting to scoop up the orders, and they're starting to it's a slow change of hands. If it was a fast change of hands, then that would be different. But this is a slow change of hands. Harley's saying, wasn't that London? No. This is California time. This gray is the London Open. Gray vertical lines are the London Open. So this was close of London, end of New York, and then Tokyo. And then finally, it busts through. If you're talking about the breakout, yes, that was London. But this building here was telling us slow change of hands. So does that answer your question, Ganster? It's a very good question. Yes, no? Okay, great. All right. I want to take a look at a euro yen as well. Pays to trade during most liquid sessions? Sure, it does. But at the same time, if you look at it this way, though, if you had traded the London session, the earliest you could have got in it was here. If you had waited, like for this formation, if you had missed it this London session, and then you had gotten it here, you would have had 20 pips less of profit than I would have had. So I'm going to disagree with you on that. Generally, more often than not, it does pay to trade the London session because there's more volatility. But at the same time, I got a far better entry. And so you're saying, but no sleep. I was up during that time, so didn't affect me one bit. Okay, let's take a look at dollar or euro yen, and then I want to get into Kiwi and gold. Oh, good, my short's live. Good to hear. Okay. So dollar yen, while dollar yen was still looking medium-term bullish, euro yen was looking very long-term bullish. Start off with the dailies real quick. Nice little pullback to the 20 MA double touch, giving a good opportunity to get back in with trend pin bar. Price continues on for 5 days in a row. I blogged about this ahead of time yesterday saying we're going to break yesterday's highs for sure, and we're probably going to make a new high on euro yen. So, in fact, I even said I'll probably buy this after the London close yesterday. Well, London close, let's get into it. We had broken the key resistance at 110.15. Here is the London close. Right there. So we broke it on the London close, and so I took a long on the break. Price action after that then forms a flag pattern. Now, the fact that it formed a flag pattern doesn't necessarily mean it's a great signal. What made it a great signal is the fact that the flag happened at the high of the day. It happened towards the highs. If a flag pattern happens in the middle, just imagine for a second, this is your high and low, and here's the flag. That's a useless flag. It's not a trend continuation signal because it's got to fight through all the order flow up to the highs, or if it breaks down, it's got to fight through all the order flow down to the lows. So that's in the middle of the range. So that's not a useful flag. A flag is only useful when it becomes the higher the low of that day's trading range, or if we're in a larger swing, it's the higher the low of that larger time frame or smaller time frame, but it has to be towards the high or low of that particular swing move. Very, very critical you understand this. So I have a flag pattern, which is now forming above my entry, just above 110.15, telling me this thing is well supported. And the buyers create a line in the sand. We get a nice little rejection off here. Now notice how price starts to levitate off the lows. When you see that levitation or price is holding off the lows there of the flag pattern and it's no longer able to get back in there, what that is communicating to you is the buyers are slowly, it's not just a slow change of hands, they're slowly buying it up at a higher price. And they're buying it up in a way that is, they're buying more of it than the sellers are, and they're buying it also at a higher price. That's why price is starting to levitate off the lows. So once I saw that, that was all communication to me that we're probably going to see an upside breakout pretty soon. Eventually, boom, that's what we get. Now immediately, price breaks back into the range. It made a high of 110.81, and then it breaks back into the range. When I see something like that, as we talked about before with the dollar yen, I'm usually looking at that saying, you know what, it's time to get out because that's a false break. Where did all the buyers go? They were present in this candle here. It closed on the highs. Price then sold off and evaporated right back into the range. So as soon as we touched back on 110.54, I was out of the trade and that was that. I moved my trailing stop up to 110.54. Done deal. I no longer want to be in this at that point. Then a brief opportunity actually presented itself. See if you can see it here. Not on these charts. I might have to pull up another chart to show you. Yeah, I need to pull up another chart and that'll be a pain in the ass. So another trade has presented itself, and I want to talk about what that trade was and why I took it. So we have the range there at 110.55. Price then breaks down to the lows of that range. You see this little high rejection right over here, 110.64? Well, price hits the 20 MA, rejects off of it twice, third time, then gets bought up and comes within 1 pip of this particular high here. The way I see it is this right here, this red candle. Let me delete this and clean this up a little bit. This red candle is a piercing candle. So we've had a strong uptrend. We had a flag. We had a break, strong buying, but then we had a false break. And that was communicated to us by pulling back into the range and creating a piercing candle of sorts. That tells me that there are sellers present in the market. So what did I do? I shorted at 110.60 and literally had a 12 pip stop and a 24 pip target. And there you go. Very simple play. It's a very, very simple play. If this is the rejection from the last time, well then there's a good chance that it could reject here again now, couldn't it? It's either it's going to reject here, or it's going to reject here, or it's going to break through. If it rejects here, fine, I can consider taking a short with a tight stop above and then play it all the way back down for a very nice R-to-R play. If it rejects here a little bit earlier, that tells me the sellers are present at a lower level. So that means they're willing to sell this at a lower level, which communicates to me they're more comfortable. They're comfortable with their position and this rejection, and they believe that that's a line in the sand. If it breaks above it, then I'm just wrong, and that's okay. I'm wrong. This thing's going to continue on, and that's it. So plays on both sides of the market there. Can everybody see from a price action perspective why I took this trade? Yes, no, it's a little bit more difficult, but it all hinges around big breakout, possibly exhaustion, reverses back into the range. Does that make sense? Yes, no? Ilya says, news not involved in the sinking? No. Didn't pay one bit of attention to it. Couldn't even care. So, Prancer says, Chris, are you in California right now? And if you are, what are you trading hours? I'm not in California. I live in Uruguay. So right now I am 4 hours behind London. Why are my charts showing California time? The FX Check and Telecharts, they work on computer time and not as particular. So they have a server time for the daily close, and they have fixed times that the daily and the 4-hour candles close. But in terms of the time that it reads, that it clocks on your chart down here, it does that based on your computer. Well, I figured out a way to get a perfect storm in terms of timing. This has got great daily candle close. The daily candle closes at the New York close, 5 p.m. New York time. Fantastic. It's a great time for the daily candles to close. You have 5 daily candles. It's a true 5-day trading week. Second thing is that the 4-hour candles close 1 hour into the London session, 5 hours into the London session, which begins New York trading. Then they close at the London close. So it's a very nice timing in terms of 4-hour candles. But if I set my computer time to California time, it will set the pivots to restart at the London Open, which is perfect. That's the best time for pivot points. And so I get a perfect storm by having all three work together. I get the pivots at the right time, I get the 4-hour candles at the right time, and I get the daily candles at the right time. It's about as ideal a setup from a timing perspective as I could ask for. So hopefully answers your question, Prancer. Jim says, where did you short? 110.60. I shorted at 110.60 at 12 pip stop, 24 pip target, done deal. Kari Hazim, how about sterling yen? I need to get into Kiwi and gold because Sylvester asked first. So if I have time after that, then I'll take a look at sterling yen. Trying Trader says, Chris, I believe you need to have experience to trade in a range like this, as there are easier trades to trade. I believe you need to have experience to trade in a range like this. Which range are you talking about? This range right here? Is this the one you're talking about, Trying Trader? I'd agree. This is something that takes experience, which is why I'm bringing it to you. How are you going to get experience if I don't expose you to new things, things that are challenging to you, things that are outside of, your current ability? I'm going to give you a combination of things that will be easy for you to spot, but I'm also going to give you a combination of things that will be challenging for you to spot. Because if I'm just giving you easy things, then the stimulation won't be there to really stimulate growth. You have to have what is called, the cognitive psychologists call the zone of proximal development. And that means that when you're taking on a new task, it has to be a combination of easy and hard. It has to be easy in the sense that there has to be the ability to succeed at it, so that success builds confidence, it builds experience, it shows you what are the right things to do, but it also has to be challenging up to your skill level so that you're constantly coming up against your boundaries, but not necessarily overextending them by too much. So by pushing up against those boundaries, that's how you stretch. That's how you stretch your capacity. If you're always working on something that's easy, you're not going to progress. I can set my chess program on my computer to, 1500 rating, and it's not going to be much of a challenging for me. Once I set it to 1900 or 2000, then I really have to work. And it's at that level that I'm being challenged and stretched. And so there has to be a combination of both. You have to be inside a zone to where it challenges you at the level of your ability, but it also gives you the opportunity to be successful at it. And when you have that, when the challenge meets your skill set and the frequency of the challenges happens at a ratio that's stimulating enough, then you get maximal growth and development. If you don't get enough setups, if you're just trading off the daily candles and you're only trading once a week, I heard some traders say, you only want to trade once a week. And it's completely ridiculous because you're not going to learn, you're not going to develop at that pace at one trade a week. Why? Because you're not going to have enough repetitions on the golf club there to really develop as a trader. You're not going to get enough swings at bat to really develop as a trader. There's not going to be enough trading decisions for you to make that you'll build up the experience and skill set, nor will it be strong enough to actually challenge you or stimulate you enough. If you just make one trade a week, more than likely you'll get bored. And if you get bored, it tends to lean towards apathy in terms of your development. And so when you're bored and there's apathy, you're not growing. So that theory of trade one time a week, it doesn't work from a cognitive or neuroscientific perspective on how learning process works. There has to be enough stimulation that you get experience, that you get repetition, and that it stimulates you enough. You don't want to overstimulate yourself, and you don't want to understimulate yourself. Neither one of those are useful. You want to find a certain frequency that works well for you. And very rarely have I found anybody to where one trade a week is enough to stimulate development and growth. If you're doing one trade a week and you're taking 2 weeks off for the holidays and then another 2 weeks off for, whatever bank holidays on it, you're only going to get 48 trades a year. That's not much repetitions or experience to build a skill set to actually make future trading decisions. 48 trades is nothing. It's absolutely nothing. There's no way you're going to really understand all the environments, how trades work out, how your systems work out from 48 trades. 48 trades will never be a large enough data set for you to really have a clear reflection of how to manage your risk, of what kind of expectancy you should have. So you spent an entire year of trading, but you won't have enough data to really even gauge your own risk based on your own performance. 48 trades is nothing. And so you've only seen 48 situations. Professionals in all fields try and get as many repetitions as they can. They don't try and overdo it, but they definitely don't underdo it one time a week. So with that being said, it's important that you have enough frequency to stimulate your experience, to build that experience and skill set. Just don't overdo it. Does that all make sense? So it's a little more than you asked for, trying trader, but that my answer is really for all of you there. Does that make sense? It's kind of like those little Chinese grips, those little things that you put on both fingers. It can't be too hard and it can't be too easy. You have to relax into it. It has to be, there has to be kind of a balance between the two. And it's only when there's a balance are you really able to slip out of it. So, okay, well, hopefully I answers your question there. Fantastic. I want to get into Kiwi. That's why beginners overtrade in the beginning to get the groove. Generally, they overtrade. And, but the thing about it is if you overtrade, you don't want to overshoot by undertrading. That tends to be the reaction. First they overtrade, then they undertrade. And then if they still have enough capital in their account and they're not wiped out, then they eventually find a balance. But you definitely don't want to undertrade either. Trading one time a week it's undertrading, and it doesn't work for the developmental or learning process from a cognitive or neuroscientific perspective. The brain just doesn't work that way. So if you embark on that program, you will never fully develop. Hopefully that explains it there. Okay, Kiwi dollar. Kiwi dollar ran into, well, we have a nice pin bar formation here, strong selling, pulls back to 20 EMA. I actually talked about the pullback to 20 EMA and selling off from there, and that's what happened. This is your line in the sand, and it's still holding the upside. So from the daily chart, until this is closed above, you're going to have a hard time convincing the overall market that the buyers are totally in control. Every time the buyers push back on this, the sellers reject it here. We can't even get a close above it. Today's candle and sell-off off of it is the strongest selling candle and single one candle rejection off of this level here to date. So that tells us that even though there was very strong buyers coming into this, they ran into a wall again, and now we've sold up pretty aggressively. The tricky thing about it is that we kind of have two levels here you have to watch, the 80.98 and 80.60. I wouldn't want to buy at 80.98, and 80.60, it's not bad. I would want to see this more on a 4-hour time frame or maybe a 1-hour time frame. This was a pin bar actually that somebody in our forum posted as well, or on the course, one of our course members posted as well. Came off really, really nicely, so up over 100 pips from entry, off that same level there. But with that being said, I think you have to watch this level here and then wait for a price action trigger. I wouldn't want to be long right now, Kiwi dollar. I would only want to be short, but I wouldn't take any new shorts at this point. This is not the location to be taking fresh short. So if you're short already, I personally would stay short, in my opinion. And if you're looking to get long, well then you could look for a trigger here at 80.98. You'd want to make sure it's a good trigger. Stops below here. Better would be to find a trigger down here. But there may be a trigger at this one here. It's a round number and a good level. So that's my thoughts on that one there. Gold. God, I hope I can get in time to the Dow. That would be great. Start off on the daily on gold. Gold is, it's in a tricky position in the sense of we're below the 20 EMA, and every time it pulls back, we still see rejections to the downside. At this point, I wouldn't consider buying gold until we get to about here. Short term, traders can look for possible price action triggers around the 1667 level. There was a good one yesterday around the same level here. It's a nice 1-hour pin bar. Right off that level here, pin bar, couple inside bars after that, boom, big sell-off. This was a good one that I had spotted yesterday here. Very nice little setup here. So sellers can look for triggers off that, or they can wait for triggers down here. I want to go back to the 4-hour though real quick. And so we're going to need a close above this before buyers really have control of it, or they've convinced anybody they have control. I would like to say that long term, I'm bullish on gold. I own physical gold. I own physical silver. I'm bullish on them. And it turns out central banks agree with me. So as the price of gold sold off massively, dropping $150 over the last week and a half, and everybody was touting the stock market and everything like that, and that gold's going to probably go into correction. Ironically, central banks were buying massive amounts of gold in the last week. The Bank of International Settlements actually reported on this, that they had bought hundreds and hundreds and hundreds of tons of gold in the last few weeks as this rose. So central banks tend not to make short-term trades like this. They tend to buy things like this if they expect the medium and the long-term prices of these to climb. And I'm expecting medium and long-term for gold to rise. Does that mean we just go ahead and buy it and we expect this thing to go up? No. You have to relate to it as is. And, I think for trading, gold is best done short term. I think for investing or buying or for owning physical, long term, I'd rather be a buyer. So, but for short term, I definitely recommend trading gold and using price action triggers off the key levels. But right now, you have your lines in the sand. That's what I'm thinking in terms of gold. So hopefully that answers your question about gold. I wouldn't want to add any shorts right now. I would want to wait till here. And if you want to add a long, I'd wait till here. Okay, so let's see here. Comments. Rob Smith 1A says, I'm understanding these days I can see you're right about the repetition. Cool. Okay, fantastic. Harley says, gold is waiting for a reason to rise again. I believe that's true. I believe it's being scooped up by large, international, multinational funds and parties and central banks, of course. I'm expecting long-term gold to continue to rise. I wouldn't be surprised if we see gold at 2,400 inside the next year. I think we'll probably, if we're going to break 2,000, I think this would be the year to do it. If I had to guess, so I'm on the recording here, we'll see if I'm right. But I think if gold is going to break the $2,000 mark, this is going to be the year to do it. And then if it does, who knows? I mean, it has a certain unlimited potential to the upside. Anyways, let's see here. Chris, why are those blue candles stacked together? This is actually an error in the data feed for some reason. The charting package is getting an error in the data feed from the broker, and they're still trying to correct that. So hopefully I answered your question. Okay. Sylvester says, last thing, I hope I'm not worrying. Second Skies Forex Facebook ID is not available. I'm pretty sure it is. Let me show you. I'll give you the link to it. Make it easier for you. I'm quite positive because it's my... There you go. So hopefully I answered your question. That should do it right there for you, though. Okay, great. 7:54. Maud, how much time do I have on Dinda? I know you guys are recording this. We're coming towards the end here. I know there is another speaker. Do I have enough time to get into anything else? Or should I be wrapping it up? You two are the overlords here. I bow to your instruction. Dow, please. Let's see if they can give me enough time. I'm going to kind of sneak in here and let's see what they say. Okay. I need a 3H monthly? A 3-hour monthly? I have a 3-hour monthly. Okay. Dow, very interesting to me. Let me take a look, show you here. Had a nice little pin bar here. Pull back into the range. Market sold off sentence. Depending on how this candle closes will determine, if we're going to see added sellers on this. If this thing closes up towards the highs, I think short-term traders will be a little reticent about adding shorts at that point. Anybody who's watching the pin bar is looking for a pullback, and they probably got this here. But if it closes really close to the highs, then that tells us there was very strong buying willing to scoop up the Dow and that it rejected all the losses on the day. So that would mean short-term traders would buy it, which means that it would probably push back up into these levels again. If these levels hold, then there could be another great opportunity to short the Dow again. I am a little bearish on the Dow, and if this thing closes, say, below 13.2, then I will expect more selling. And so I will look for a possible return back to here in the 20MA 13.050. That's what I would be expecting in the near term. After that, we need to see it close below 13,000 and the 20MA for that to put pressure on the sellers. What that would do is that would trigger, first of all, you're triggering a big figure, 13,000, but you're also triggering technical models that will sell on the break and close below the 20MA. So that's what I'm expecting if that scenario were to play itself out. If I do look on the 4-hour chart, we can see a possible pin bar formation right down here. So we'll have to see how that plays itself out. There's still another hour for this one to go. If that's the case, we could see a pullback to here. But we really need to wait. If you want to sell, I like selling more closer up to 13.2. Me personally, I'd like to sell between 13.2 and 225. That would be more my preference with stops just above, maybe above these highs over here. But I would say you need to wait another hour for this candle to close. But short term, I'm a little bit bearish. If this thing continues and it clears 13.2, then short term I would be bullish on it. So we'll see. But we could be witnessing the possible unwinding, the beginning of a Dow unwinding. This is the first time it's been below the 20 EMA or closed below it since March 7th. So you're talking 3 weeks. It's been floating above it. It's been very strong. Also, if we go back to a daily chart, all these lines, this little move right here is the strongest in all this. This all was done through vapor thin volume. And then all of a sudden, boom, very, very strong buying. So was that exhaustion? Was it a last final push? Possibly. Certainly could be. So we'll see. We'll need to see how this candle closes before we get our answer. So that's my thoughts on Dow, but we could very well be witnessing a major breakdown in Dow. All right. Fantastic. So with that being said, I have to wrap it up. So thank you all very much for coming. It was fantastic having all of you here. Also some great questions across the board. Keep coming back to these webinars again and again and again. By coming back to these webinars, that's how you grow, that's how you learn. By asking questions, that's how you learn. The more you participate in the process, the better your learning experience will be, and the more connections you'll make in your brain and your synapses, that you'll develop, and that will just lead to stronger understanding and learning. So continually participate, keep coming back. If you have any questions, don't hesitate to check out my website, secondskiesforex.com, or email me with any further questions at info@secondskies.com. So until then, I hope you enjoyed that. Thank you all for here. Good luck trading, and I'll see you guys next week. Take care, everyone.